let's put the spotlight on GoFashions, a recently IPO'd stock which has come out with its numbers. What we've actually started to see is that the third quarter revenue as well as the EBITDA has registered a decent jump in the quarter that's under review. The top management now live with us, Gautam Saraogi, the CEO of GoFashions. Good morning. Thanks so much for joining us here. Now, there was a lot that was being said about a slowdown, recession, inflation that's going to be impacting demand. You managed to counter all of that. How and how sustainable is this?
See, quarter three was a good quarter. I wouldn't call it an excellent quarter because as management, we thought we could have probably done a little better from a top line revenue perspective, though this is the highest quarterly revenue we posted, but we felt we could have done a little better. The market in quarter three had its own ups and downs. October during festive did very well. We had then a huge fall in November. Then December picked up again. So overall, if I look at the entire quarter three, it has been a good quarter. Could have been better. From quarter four perspective, we are quite bullish about quarter four. January has started out well and done pretty decent and better than decent, I would say. So we're quite bullish about quarter four.
Always say, right? It's still day one, so you could still do better. But on a more serious note, I'm going through the fine print now. And if I look at the same store sales growth, GoFashions registering a 10% uptick year on year. Break this down for us. Let's talk about the volumes that you get from this, the kind of value that you get from this, and what is the target that you've given to your team for increasing that same store sales growth number?
Yeah, sure. See, from an SSSG perspective, we have reported 10% same-store sales growth compared to quarter three last year at a value level. And see, for us, last year, Q3 was better than pre-COVID. So whatever comparisons we are doing for quarter three are based compared to last year because last year did better than pre-COVID. So at a value level, we've done about 10%, and at a volume level, we've actually had negative growth. We are currently at about -2%. But see, having said that, we feel that we are more than an SSSG business. We are a same cluster sales growth business. So what same cluster sales growth means is we are opening a lot more number of stores in the same micro locality. So rather than looking at each store individually, we are looking at that micro locality, otherwise known as cluster, as one outlet. So on a same cluster sales growth basis, we have reported a 24% 24% value growth in Q3 compared to last year, and 11% volume growth compared to Q3 last year. So even though our SSSG has been at a volume level at -2%, at a sales cluster sales growth approach, we have been at 11%. So moving forward, SCSG, which is same cluster sales growth, is going to be a very important metric. But having said that, even at a SSG perspective, we will aim to target about 4 to 5% volume growth, even at a same store sales growth level.
Gautam, now the average selling price has gone up from 709 in Q2 to about 724 in Q3. What has led to this rise? Is it a better sales mix or a price hike?
No, we have not taken any price hikes. This is more to do with the products what we are introducing are slightly of a higher selling price. See, the last price hike what we had taken was in December 21, and after that we have not taken any real price hikes. So this is more to do with the new product mix what we've introduced, which is of a slightly higher selling.
Cotton prices as well have declined from the peak of about 1 lakh per candy to somewhere between 60 to 70,000. Sorry, that was 1,000, pardon me. What do you think, the benefits of these lower input costs should be trickling in soon, and would you be looking at passing on the benefits then to customers, perhaps with price reductions?
See, this benefit of the raw material prices going down, it will take a lot of time to show up in our gross margin because, see, the prices have just gone down. So the newer inventory, what we buy, the newer raw materials of garments, what we buy will be on the newer price. So this will take and we currently have a lot of stock in-house already, which was purchased at the older price. So this will take a very long time for it to show up in the gross margin as far as gross profit is concerned. As far as reducing a pricing is concerned, we are currently not thinking of reducing a pricing. We don't know the sustainabilities of these reduced cotton prices. So we'll have to wait for 2-3 quarters to see how long does this reduced price continues. So currently there are no plans to reduce prices for us from a selling price perspective.
Right. But, given the rapid expansion of stores and a cluster-based approach, have you witnessed cannibalization of volumes from the existing ones?
Yeah, so we have witnessed that in Q3, where we have seen certain times certain stores are getting cannibalized. But the jump in revenue we are seeing as a cluster, that's very sequentially higher than what we would see at a same store sales growth level. So some stores, because we are opening in a more number of stores in the same cluster, some stores do cannibalize. But we haven't seen the margins getting impacted because the cost, the jump in revenue is far higher in the cluster than the jump in cost of adding those additional stores in that same cluster. So we have not seen any margin impact as such, though some stores have got cannibalized.
Right. Because you have an 8% market share currently, with store expansion, advertising, campaigns underway, what is the market share that you're targeting?
See, currently we are spending a lot on brand building. So this year we would be spending about 3 to 4% of our revenue on brand building. See, for us, our biggest mileage and branding is our own stores, which you see across malls, high streets, and airports. And we are adding about 120 to 130 stores. So those act as our biggest advertising medium. So over and above that, we really don't have to materially spend on advertising and branding. But having said that, we do spend about 3 to 4% to build, to invest in brand building. So on a yearly basis, we are looking to grow at a long-term CAGR of 20% and more. And as our revenue base increases, I think our market share also will sequentially increase parallel.
Okay, Gautam, we're going to leave it at that. You were to see the Go Colors stock trading with a dash of red, tiny bit in the red. We'll take a short commercial break, but stay tuned. A lot more coming up on the other side. We'll touch base with our charters for the Chartbuster segment as well. See you in 2 minutes.